This week's market update. Shares rally as trade war fears retreat. A new record for the FTSE 100 as currencies and commodities boost UK stocks. And Italy puts downward pressure on the euro. Sentiment in the equity markets around the world was upbeat at the start of this week after US Treasury Secretary Steven Mnuchin said Washington had halted plans to impose tariffs on up to $150 billion of imports. "We're putting the trade war on hold," was how he put it. The de-escalation of trade tensions followed the issue of a joint statement from the US and China on Saturday, in which Beijing promised to significantly increase its purchases of American farm exports and energy. Both sides said they would continue to talk over the summer. The prospect of peace breaking out helped push the price of corn up to a near two-year high. It wasn't all good news. There was a shortage of detail, and some observers said the vagueness of the statement showed the scale of the gap between the two sides still. But given the scale of the damage a full-blown trade conflict would inflict on the global economy, even the scraps of hope offered by the communiqué were welcomed by investors. The good news was felt everywhere, and not least in the UK, where it was a case of another week, another record for the FTSE 100. Despite a string of gloomy headlines in Britain, apart from the royal wedding of course, the main stock market index hit a new intraday high on Monday as a weak pound and rising commodity prices gave UK shares a lift. Rising above 7,800 for the first time, the London index has now risen by more than 14% from its March low. Over the course of 2018 to date, the index is up just 1.8%. Sluggish economic growth and Brexit uncertainty might seem like a poor backdrop for the stock market, but there's always been a disconnect between the economic and political headlines in Britain and the performance of shares. The FTSE 100 is more internationally focused than most of its rival benchmarks, and that means it's driven more by what is going on in the global economy than by domestic issues. For the same reason, another key influence on the FTSE 100 is the level of the pound. With 70% or so of FTSE 100 constituents' profits coming from overseas, a weak pound makes these earnings more valuable when they're brought home for shareholders. The UK benchmark is also particularly exposed to the commodity markets, given the size of key stocks like BP, Shell, Rio Tinto and others. The recent strength in the oil price is therefore a net positive for UK shares. Currencies and commodities are the two main market stories this week. On the currency front, it's all about the dollar, which is rising across the board. The dollar is rising largely because of interest rate differentials between the US and other major economies. The Federal Reserve seems locked into its rate hiking path, while other central banks are much more cautious. And that process looks to have a way to run, with some economists arguing that the 10-year Treasury bond yield should be between 4 and 4.5% on the basis of growth and inflation expectations. That, of course, compares with today's level of just over 3% and suggests more upward pressure on the dollar in the months ahead as rising yields make it more attractive for investors to hold US assets. One set of US assets in particular has benefited during the recent period of strength for the dollar. Smaller companies are viewed by investors as less impacted by currency strength than bigger companies, and they've outperformed significantly since the beginning of the year. The flip side of dollar strength is naturally weakness for the euro, for the pound, yen, and emerging market currencies too. While a weaker currency is considered a net benefit for the main developed markets because it makes their exports more competitive, dollar strength is usually bad news for emerging markets. That's because a rising dollar lifts the cost of servicing dollar-denominated borrowings for both emerging market governments and companies. It also increases the cost of dollar-priced imports, pushing inflation higher and forcing developing countries to raise interest rates to support their currencies. We've already seen examples of this in Argentina and Turkey, but there are plenty of other emerging economies at risk, from South Africa to Indonesia and elsewhere. On the commodity front, the big story continues to be oil. And here, the key question is whether $80 a barrel oil will start to eat into demand. The first grumbles are starting to be heard from oil-intensive industries like airlines and mining, which are flagging the high cost of crude as a potential squeeze on profits. Oil climbed above $80 last week for the first time in 4 years. It was the 6th weekly increase on the trot as investors focused on US sanctions against Iran, the political and economic crisis in Venezuela, and the still buoyant state of the global economy. That combination has provided the perfect backdrop for OPEC and Russia's output curbs to have maximum impact, and the rise in the price of oil has been dramatic. But how long before $80 oil starts to be felt by consumers? Already, petrol prices are rising, and the RAC has warned of another 2 pence a litre rise by the end of the month. Were the oil price to head towards $100, then the impact would be painful. And not just here. In many emerging markets, governments used the 2014-16 price slide to remove or reduce fuel subsidies, and higher prices would be particularly damaging in these economies. At home, the most obvious impact might be on the inflation rate, which last month fell unexpectedly to 2.5% against expectations of 2.7%. That meant that household earnings rose more quickly than the cost of living for a second month running. But that happy state of affairs might be short-lived if fuel prices push CPI higher. The next reading is due on Wednesday this week. Another key focus for investors this week continues to be Italy, where the prospect of an anti-establishment, anti-EU coalition is firming. The growing likelihood of a high-spending, Russia-leaning, five-star League government has been felt first and foremost in the Italian bond market. It's one of the world's largest after years of government deficits. The yield on the 10-year Italian bond, the BTP, has risen to more than 2.29%. That's back to levels last touched in October and not exceeded since last summer. At the start of last week, before it became clear what the ruling coalition's policies would be, the yield stood at just 1.89%. At today's level, the premium demanded by investors for holding Italian rather than safer German debt has reached 1.7 percentage points. That's the widest in 7 months. Fears about Italy, the Eurozone's third largest economy, are also weighing on the euro, which is at its weakest since November at around $1.17. The Italian equity market is also feeling the heat, down more than 2% in early Monday trading as investors prepared themselves for a testing period in the markets as it becomes clear just how confrontational the government will be with the EU. And finally, on the corporate front this week, there's a smattering of results, mainly on this side of the pond. Retailers in focus again, with figures due from both M&S and Halfords. Ryanair yesterday announced strong annual results, but it warned that 2019 will be tougher as jet fuel prices rise, staff costs increase, and the risk of a cliff-edge Brexit looms.